If you looked at CPI and payrolls and we didn't have a banking collapse, would the conversation this morning be this Fed might be going 50? Except that's not the conversation, is it? S&P 500 futures up by more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York coming up, battered bank stocks looking to bounce, calls building for Chair Powell to hit pause as elevated inflation keeps the pressure on. We begin with the big issue. The market says the Fed is done. The latest data says it's not.
You got a little bit of whiff of financial instability.
The market is telling the Fed to be done.
Doesn't change the fact that we have inflation still above trend here, and that has to come down.
The market doesn't care that the inflation is still there.
This is a very, very difficult environment now.
The risk of something breaking is now tilting to be a little bit higher than the risk of runaway inflation.
The Federal Reserve is moving to slow inflation. That is going to have collateral damage along the way.
They put a pretty big bazooka in place with that BTFP program on Sunday. I think they're going to point to that.
It's very soon to make a call on the Fed being done.
US CPI could still be important.
It all depends on what the financial markets do this week.
The data would say you need to hike, and we've got financial stability risks pointing the other way.
Let's get straight into it with Lafayette's Krishna Mamani, Kathy Jones of Charles Schwab. To the two of you, thanks for being with us. We're about 29 minutes away from that open, with equities up more than 1%. Kathy, I know this is a difficult exercise, but go with me. If we could put the financial stability concerns to one side, and you looked at payrolls and you looked at CPI, would your base case be 50 for next week?
No, it'd be 25. I don't think that there's, even putting aside the financial instability issue, I don't think that there's a compelling case for the Fed to keep raising at 50 basis points a meeting. After all, we've already seen financial conditions tighten outside of what's happened over the past week or so. The senior loan officer survey has shown tightening credit conditions. We've seen a deceleration in inflation. Some good news on the wage growth side. That starts to ease. So I think 25 would have been my base case, even aside from everything that's happened.
Krishna, a lot's happened. Where are you on the Fed now, based on what we've heard so far?
Well, so I agree with Kathy. I think the likelihood of 50, even with this number, probably was modest. And this ensures, or the financial instability ensures, that it probably is not going to be 50 for sure. But for it not to be 25, I think that is a challenging case as well, especially based on the data and the fact that the Fed loses its optionality to tighten if things get worse down the road if they pause today. Because if they pause today, much the way that they are having difficulty ramping it back up to 50 from what they were doing earlier after cutting it down to 25, if they pause today, the likelihood that they can continue tightening, that optionality withers a little bit.
Well, Krishna, look at the calls to pause. Goldman Sachs, pause. Wells Fargo, pause. Barclays, they say pause. There is a whole host of banks now on Wall Street that say pause. NatWest, pause. Nomura goes one further. Take a listen to this. They say in reaction to looming financial stability risks, we now expect the Fed to cut rates, 25 basis points, beginning in March. We also expect the Fed to stop QT. What do you say back to that, Krishna?
Well, so I think there is a case to be made for pausing. Having said that, I think the Fed has to be mindful of the fact that inflation is still very, very high relative to what they're shooting for. And the underlying momentum in the economy is still quite strong. So it's not that the case for pause is zero. That's not the case. It's just that the preponderance of data is still pointing towards inflationary pressures, and the Fed has to have its eye on that particular issue. I think calling for a cut in this meeting is a little bit of a stretch for sure. That's more staking a position out rather than it being a realistic thing.
Well, we'll see in a week, and a week is a long time based on what we've seen over the last couple of days, that's for sure. Kathy, I got a message in the last hour. It said, I strongly believe they should hike based on the data. I don't trust them, though. Would you say back to that?
Well, I don't know about the trust thing. I think the problem is that the Fed has been all over the place with its messaging, so it's unclear what's important to them any given moment, and that I think is a problem. I do think that their commitment to fighting inflation is intact, but I also think financial stability trumps inflation fighting in the short run. And in order to hike at the next meeting, they're going to have to feel very confident that the financial stability issues have been resolved. The other thing I'd point out is, there's these long lag effects from tightening, and the market is telling the Fed quite clearly that it should be done. So with the tightening moves, and they're still doing QT. We have a steeply inverted yield curve. All of that would suggest to me that the market signaling is saying, hey, you've really done enough. The Fed is, though, trying to protect its kind of inflation-fighting credibility. So it's kind of a toss-up to me as to what they choose to do. But I don't think it's a matter of trust. I think it's a matter of perhaps not great communication on the part of the Fed.
Well, the market's screaming that they're done right now. On Wall Street, there's very little consensus when you listen to the economists, but the market, just looking at market pricing, which is just a way of aggregating all of this market is screaming they are done. Krishna, there is a psychological question I'd love your insight on. And it goes a little something like this. If they don't hike next week in response to incoming data, are they undermining what they announced Sunday evening? In other words, are they basically acknowledging that what they announced Sunday evening together with the Treasury and the FDIC is insufficient to insulate the financial system?
Well, I think I don't think they will go down that path so easily. That is, I think they're likely to stick to the script that they have done enough, and if required for financial stability, they will do more in terms of providing liquidity to the banking system and do whatever that needs to be done. But I think Kathy's point is a good one, which is, yes, it is a toss-up, but even in that toss-up environment, if the economic momentum in the and the inflationary momentum in the economy is as elevated as it is, I think if they don't do anything, their credibility will be hit, and they're very, very, very aware of that, I'm pretty sure.
Just getting some headlines from Meta, from Facebook and Mark Zuckerberg. These headlines widely expected after the reports of the last week or so. Meta Platforms expecting to cut the team size by around 10,000 people, largely in line with expectations. There is an important line here, though. Meta to close around 5,000 additional open roles. That stock is positive by about 1.85%. They expect to announce layoffs in the business groups in late May, in tech groups in late April. Further cuts to the size of the recruiting team as well, as you might expect. So that stock's up by about 1.9%. That's not the focus of our attention this morning. Mike McKee, the focus of our attention is on you and the data so far going into the Fed next week.
Well, gee, I'm flattered. The data probably flatter the Fed a little bit here in the sense that they keep us on the same narrative that we were on before the banks started to go bad. And so it looks like maybe 25 is the way to go at this point, where you've got headline coming in as expected. The only real out of expectations number was the core monthly up 0.5% compared to 0.4%. And a lot of that comes from the service side, particularly housing, up 0.7%, rent up 0.7%. That hasn't started to come down yet, and a lot of people are waiting for that. When it does, we should see a much more significant drop in inflation. The Powell indicator here does show some good news in one area, and that's goods and services inflation, but services core services ex housing comes down another 0.2 from 6.2 to just over 6, and that does suggest some pressure easing in that area, but services prices overall still going up, something the Fed's keeping an eye on. And if you take apart the numbers, you could see that there were increases in food away from home, especially at restaurants, does suggest that maybe there's some wage pressure in that area still. Where does it all leave us? Well, the latest Fed funds vote is that we're probably back on for a rate increase, the terminal index going up a little bit after the release of the Fed numbers. And John, of course, when you look at the bank stocks this morning in the pre-market trading, they're all up. The other good news is egg prices fell 7%. So it looks like that crisis is over too.
That's the news you need to know. Mike, thanks for that. As always, Mike McKee there, breaking things down for you. Let's break this down. Two-year yield in America last Wednesday, north of 5%. Yesterday at the close, south of 4. This morning, up 31 basis points to 4.29. Now, Kathy, I'm sure you've had the conversation about what an inverted yield curve means with your clients, and often it means bad things. But equally, you've also got to explain why a bull steepener can also mean bad things. What do you make of the development that we've seen at the front end of the curve in the last couple of days, and what on earth does that signal?
Well, it's certainly been incredibly volatile, and I think that just reflects the combination of the liquidity considerations, the banking considerations, and the inflation and uncertainty about Fed policy. But yeah, the conversation we've been having is that as the curve begins to re-steepen or become less inverted, that usually is because we're headed into a recession. You know, that happens as you head into a slowdown in the economy, and the expectations are that short rates will come down and the whole curve comes down, but short rates come down faster than long rates. So it is another signal that, you know, perhaps the Fed is pretty close to being done. They may not be all the way done. We might get another 25. It seems like that's in the cards right now, but I think what we're seeing both in the economic indicators and the future leading indicators on inflation, this and the market action, it suggests to me that we're pretty close to being done in terms of Fed rate hikes, and that is a reflection of slowing economic growth on the horizon.
Typically, that's not a great time to buy equities. Krishna, last time we caught up with you, you said the pain trade was 4,500 on the S&P. Has that view changed, one? And two, what's the pain trade now?
Well, I think the biggest pain trade really was yesterday, which is people who were short rates in a big way, and they had to reposition. That certainly wasn't something that most of us were expecting ahead of the financial stability issues. I would say from an equity standpoint, the pain trade still very much is by the middle of the year, S&P 500 at 4,500. Again, most of us don't expect that. It is a pain trade for that very reason.
Yeah.
But I think if one can make a case that the outlook for a soft landing has actually improved rather than deteriorated because of this episode, because the Fed probably stops earlier, and credit growth, which would be one of the issues to kind of deal with, certainly would slow down as a result of this episode.
Krishna, stopping early because things are breaking. Is that bullish?
Well, things are breaking, but you know, things are breaking very modestly. I think people, when they compare this to 2008, clearly weren't there in 2008, because this isn't us talking about.
Krishna, can I jump in now? Forgive me, because we're up against the clock, and that's just the downside of TV. Let me just jump in. We always do this, and it drives me nuts. I get it. A lot of people that we talk to have been on the street for decades. I understand it. But when they see things like it's not 1999 or 2000 or it's not 2008, I don't understand that. Why are we benchmarking to extremes to make the case that things are okay? It might not be 2000 in tech. It might not be 08 in banks. That doesn't mean it's okay, though. That just means it's not as extreme as those times. I don't think that's a good benchmark. Do you?
No, it isn't a good benchmark. But I think what you have to kind of factor in, along with all the issues that we are talking about, is the fact that the economy has substantial amount of momentum, and fiscal spending is still on the dock in terms of future spend. So the economic momentum is quite substantial. You know, it may not turn out the way we expect, but saying that the likelihood of that and things are breaking in a very big way, I think that would be an overstatement as well.
Krishna, always appreciate perspective. Thank you, sir. Krishna Mamani alongside Kathy Jones, two of the best on the street on fixed income and a whole lot more. Your equity market just about positive, nicely so actually, by more than 1%. With the latest on some stock moves, here's Katie Greifeld.
John, what a difference a day makes, at least when it comes to bank stocks. Let's start with KRE. That's your regional banks ETF. It's up double digits pre-market, up about 10% or so. First Republic, Western Alliance, some of your biggest gainers there. Both banks posted record drops yesterday, now up to the tune of 50% or so. Remember that they had been put on downgrade review, but clearly not a concern for the shares today.
Katie, thank you. Coming up, battered banks bouncing back.
When the Fed does pause, history says that they start to cut rates 9 months later, and that the S&P is up 13%, led by the financials up on average more than 22%.
The brilliant Erica Najarian of UBS up next.
Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
President Biden defending the U.S. banking system after regulators stepped in to ease concerns of contagion. It wasn't enough to calm this market yesterday. First Republic ending the day down by more than 60%, Western Alliance by almost 50%. The regionals staging a comeback this morning at least after clocking record losses in the wake of SVB's collapse. Kaylee Lyons has more. Hey, Kaylee.
Hey, John, yeah, it seems like the markets are maybe buying more into the idea that these regulatory actions could stem the bleeding or contagion, at least for now, because you are seeing a pretty sizable rebound, almost to the extent that you saw a sizable selling pressure in yesterday's session taking place on this Tuesday morning. Right now, that regional banks ETF, KRE, is the ticker, up about 11% in pre-market trading, while the select financials ETF as a whole, so a wider view of the banking sector, is up by about 4%. Remember, those are pretty much comparable to the losses yesterday when that regional ETF was down about 12% in the Monday session. All that said, the rebound we are seeing today only goes so far to undo the pain we have seen over the course of several trading days, because between last Wednesday and the close yesterday, we have seen hundreds of billions of dollars wiped off the market value of bank shares globally. Just to take a few examples, Charles Schwab down nearly $45 billion in value over just the course of a few days. Bank of America, Wells Fargo, JP Morgan seeing tens of billions of dollars wiped out. And First Republic, $15.6 billion in market cap lost. It was a $22 billion company last Wednesday. So that is almost a very significant chunk of its market value. And actually, even though we are seeing this rebound today, it would need a 268% rally to reach its closing level from a week ago. The rebound today is coming despite the fact that we had Moody's putting First Republic and 5 other lenders put on review for a downgrade, citing concerns about deposits. But it seems like there is a buying of the dip here, John, and that may be due to momentum, considering these banks were deeply in oversold territory.
Katie, thank you. We'll come back to you in about 10 minutes, 11 minutes time around the opening bell. Erica Najarian of UBS has this to say on the regionals. The outlook is clear. They will be negatively impacted by what is likely to be higher costs to keep depositors, and later by tougher regulation. Suddenly, we think the industry could be hoping for rate cuts for deposit flow, cost and unrealized loss relief. Erica, I'm pleased to say, joins us right now. Erica, thanks for being with us. Can we just start with what was announced on Sunday? I think that's the right place to start. Do you think that was sufficient?
I do. So think about it this way, right? The Fed essentially could not resolve the sale of either Silicon Valley Bank or Signature over the weekend. And if they didn't introduce this facility, then you certainly would have had contagion risk, as everybody would start freaking out and put their deposits in the largest banks in the United States. I think this facility is actually quite brilliant because it allows banks that need it to tap into liquidity without crystallizing the unrealized losses on their bond portfolios. Keep in mind, one of the most important aspects of this facility is that the Fed is going to lend to the banks at the par value of their securities collateral.
Can we just build on that a little bit, Erica? You're best positioned to answer this, and I don't know the answer to it. Do some of these regional banks, though, have the right asset mix to access that facility? I understand this was set up in the wake of what happened with SVB, and clearly they did. I'm talking about what happened with treasuries, the duration mismatch, etc., mortgage-backed securities, all of the above. Erica, do you see the other banks having the right asset mix to access that facility?
Yes, so most U.S. banks have U.S. Treasuries or agency MBS in their securities portfolio. So that is the proper collateral mix to tap into that facility. Keep in mind that you can pledge muni bonds for those banks that have muni bonds against a discount window. So that's not necessarily closed to institutions that could have different collateral to post.
Is there a stigma attached, though, with going to the discount window?
Look, potentially, right? But I think that at the end of the day, we're not going to necessarily know who's tapped into either the new Fed facility or the discount window, potentially until earnings in April, right? And a lot can happen in terms of the markets calming down between now and then. And again, you know, you just talked about how the KRE is bouncing pretty heavily off of yesterday's lows. You know, sometimes the stock market could be its own mechanism for confidence. And if we have a recovery, right? And essentially, what if we have no more bad news in terms of bank seizures or failures by the end of the week, I think we could see confidence restore in the banking system, especially as Silicon Valley Bank deposit holders and Signature Bank deposit holders were both made whole.
Let's go to the major players. I think if a lot of people were thinking about moving banks over the weekend, they would have been thinking about moving to the SIBs, these big institutions, too big to fail, to make it very simple. Erica, do you see more reasons to buy them now as opposed to sell them?
Yes, absolutely. So, you know, keep in mind that these banking institutions already have the most stringent requirements on capital, and not just that, on liquidity, right? So those institutions, for example, have to hold $1 of liquidity for every dollar of excess cash, right? A non-operational deposit. So already they're under the most stringent rules. And of course, because they, you know, JP Morgan makes something like $140 billion of revenue, right? Their tech in terms of being able to provide, you know, treasury management, for example, for companies, you know, tends to be, you know, quite superior. And so, yes, I think they're the big winners in this. And I think at the end of the day, what the ironic part about this is, you know, again, I heard you just a bit ago in terms of not comparing to the financial crisis.
Yeah.
Ironically, right? Ironically, I think that institutional investors and retail investors will assign a higher multiple to large bank stocks, the old too big to fail camp, right? Because of the flight to quality and the perceived safety.
Not the first time we've heard that in the last 24 hours. Erica, thanks for being with us. Let's catch up soon. Erica Najarian there of UBS. Up next, your morning calls. Good to see the good people at Strategas ring the opening bell at the NYSE. That's nice. Enough of that. Equity futures right now on the S&P up by about 1.4%. On the S&P 500. On the Nasdaq up by 1.25. Previous 3 days, 3-day losing streak on the S&P 500. And some monster moves in the bond market. That's the opening bell. Switch at the board and get to the bond market. 10-year yields higher by about a basis point. It's been all over the place. 358.84. Take a look at the front end of the curve, though. You've got to look at the 2-year over the last 4 days. Last Wednesday, north of 5%. Yesterday at the close, south of 4%. This morning, up 27 basis points. Your 2-year, 426. This came from Neil Dutter of Renaissance Macro a little bit earlier this morning, about 20 minutes ago. Said today's CPI inflation data make it clear that the effort to quell inflation is far from complete. Had it not been for SVB, the Fed would have likely moved 50 basis points in March. Instead, he still sees them going 25. Bear in mind, looking at euro dollar at 107.30, there's still an ECB decision to come this week. The ECB were talking up 50, almost pre-committing to it. Dare I say they did pre-commit. Let's see what they do on Thursday, given this bank stuff. Elsewhere, looking at crude, down 2.4%, just about holding on to the 70s, 72, 73-ish. We're down about 2.5%. 50 seconds into this, we advanced by 1.3% on the S&P, on the Nasdaq up by 1.6. One sector to watch. It's the banks. Regional banks bouncing back after 6 days of losses, capping their longest losing streak in more than 5 months, with some major declines yesterday. Kelly Lyons has more. Hey, Kaylee.
Well, John, the gains this morning are almost as jaw-dropping as the losses of yesterday. Looking at the likes of First Republic right now up 58%. You have Western Alliance up 52%. PacWest also is up by more than 50%. So certainly a remarkable rebound, perhaps some buying of the dip here. I would just note that these banks have a lot farther to go to recover all of the losses seen over the course of the last week. First Republic would need to rally 268% in order to reach its closing level from a week ago. PacWest would need to jump 174%. Still, today is a start. We'll see if it sticks. Also, you are seeing a rally in some of those bigger banks, which at first were a bit insulated from some of these deep losses, but they were not immune to it yesterday. However, they too are participating in the rebound. We have the likes of Citi, Bank of America, Wells Fargo up in the tune between 5 and 7%. And according to Bloomberg's reporting, we also understand that these banks already are reaping the benefit of concern about a crisis in smaller banks. We know that JP Morgan has had billions of dollars in depositors coming in recent days, and the other banks are seeing higher than usual volume as well, according to people familiar with the matter who have spoken to Bloomberg. So that may just make too big to fail banks even bigger and maybe even continue their string of outperformance, given they are bigger and more diversified. That is what has helped lead the outperformance relative to regional banks, who are really the focus of concern when it comes to this duration gap and the mismatch between assets and liabilities and the vulnerability to the Fed's continued rate hikes.
Kelly Knight. Kelly, thank you. Maybe is perhaps the word we should be using for next week. Kelly, thank you very much. Kelly will stay close for the next 30 minutes as we work our way through some of this. Major bounce for you. Looking at United Airlines as well. United warning of a surprise loss this quarter amid higher labour costs. This coming after the company delivered an upbeat outlook back in January. Katie's back with us for more. Katie, what happened here?
It's obviously surprising if you look at the shares down about 5% or so. And you look at what analysts had been expecting. The average expectation among analysts were for a profit of 69 cents. Now the company disclosed in an SEC filing last night that it sees an adjusted loss between 60 cents and $1 in the first quarter. That is a wide range. And a lot of this, of course, comes back to labor costs and a potential deal with its pilot union. That is going to result in earlier expenses this quarter rather than next quarter. And we know that American, Delta, they're dealing with similar labor agreements, and that's weighing on profitability. Even though airlines are enjoying very strong demand, that is especially true for United. And disclosing this loss, they also said that operating revenue, it's going to be up 51% in the first quarter, and it posted record sales per average seat miles. But as we're all learning, John, sales do not equal profit necessarily.
Katie, thanks for that. That's the latest on United. Their stock is down by more than 6%. Meta, it's the year of efficiency. Meta's up by 4.6% in early trading. This is Facebook, of course. Mark Zuckerberg a little bit earlier announcing 10,000 job cuts, also closing around 5,000 additional open roles. Zuckerberg says this: over the next couple of months, organization leaders will announce restructuring plans focused on flattening our organizations, cancelling lower priority projects and reducing our hiring rates. So that's the latest from them. That stock is up by 4.5% from Facebook this morning. Let's turn to Credit Suisse. The shares rebounding a little bit. They were down hard over the last couple of days. They're up right now. The CEO seeing signs of confidence as the lender executes its turnaround plan.
So far, it's pretty calm. We even saw material good inflows yesterday still. Also, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at that.
Stock is up just about by 1%. Shanali has more. Hey, Shanali.
John, remember, they hit record lows before rebounding just a little bit. Credit Suisse is already trading at about 20% of its book value here when you take a look at it. But listen, they uttered some of the dirtier words in finance, which are material weaknesses when it comes to its reporting and controls. Now, we know that Credit Suisse has had a lot of issues when it comes to its controls. But again, we are watching them through this turnaround plan, so it is difficult for investors to keep watching them hit these roadblocks as they look to turn around. Now, the CEO did talk to Bloomberg earlier today. One positive sign is that yesterday, in a day of panic, they saw inflows. Now, they are still seeing broadly outflows, but those outflows are soaring. I think that CDS picture here is a really important story. We've been talking about it a lot, but just take a look at just how historic it's trading at. The widening of these credit spreads here, that tells a bigger story than the stock, I would say, which is already trading at historic lows. This here is the fear under the market when it comes to Credit Suisse. Globally important, systemically important bank. As we've been talking about, it has been trading at 20% of book value. But again, they are in the middle of a turning around story. So what is the story to start getting in? What is the story to buy? It will take years before that CSFP IPO starts to take wind. The CEO said that they are still searching for an investor, a large investor. They have not yet secured more money for that unit. So again, very much in the center of a turnaround story here with a drip of bad news today.
Will we see evidence of that turnaround, Shanali, by the time we get earnings? I think it's April 27th. And Shanali, given how quickly things move in this market these days, Shanali, for me, I don't know about you, but April 27th feels like a long way away.
It definitely is a long time away. And if you take a look at just the last week in the market alone, a lot can happen between now and then. Again, the idea here that they got inflows on a day like yesterday is an important part of the story, because it's part of that story you've been hearing. Even Credit Suisse, you're seeing systemically important banks be an important part of the story, because we have a big existential question here about the meaning of a government backstop.
It was a great conversation with Francine. Enjoyed the interview on Bloomberg Surveillance, and to those of you that missed it, please rewatch it. It wasn't clear whether that was net inflows, though, Shanali. Did that stand out for you?
It did, but the idea here, remember, this is a person here. Remember, Credit Suisse has recently got in trouble from regulators because of potentially misleading statements. So you have to understand here that when the executives are speaking, they are speaking with a heck of a lot of caution while they're trying to clamp down here on a lot of negative energy behind the stock.
A much-needed bounce, although I don't know if you can call this a bounce. We're up by 1%, 228 on Credit Suisse. Shanali, great work as always. Bob Dollar-Crossmark, questioning the Fed's higher for longer narrative after the SVB's fallout, says this: credit and liquidity events cause uncertainty and hesitation. This will slow the economy and accomplish some of the Fed's work for them. Bob Dole joins us right now. Bob, let's take it easy. I just need to take a breath for a moment. What a couple of days. Bob Dole, what do you make of what you've seen?
Unbelievable. I mean, to think that the 2-year down 100 basis points in a few days, up 25, it's like a volatile growth stock. It's incredible what's going on.
Do you like the banks right now, Bob? Because I know there's been a sell-off. Some people think it's an opportunity. I want to be very clear about where they think that opportunity is. Some people think it's in the big names. This came from Marko Kolanovic at JP Morgan. He said, we believe the sell-off in large-cap banks was overdone, as they have a lot more liquidity than smaller banks. They are more diversified with broader business models, have a lot of capital, are much better managed with regard to risk, and have a lot of oversight from regulators. Do you like what you see there, Bob?
Yeah, I think the financials and the banks in particular are one of the cheapest sectors in the market. Obviously, there are a lot of cross currents here, but their balance sheets are in much better shape than they were at any time before prior recessions. So I'm of the view that, especially on weakness, I did a little nibbling on Friday, a little more tomorrow. On a big up day, I'm unlikely to buy some more, but on pullbacks, I would add to the banks.
But these are the large cap banks, to be clear, Bob. That's what you've been buying?
Yes, sir.
OK, what about outside of that? Because yesterday you saw in the session a clear distinction between the financials underperforming, quite rate-sensitive story at the top of the pile, the usual movers you might expect, real estate, utilities, tech. Anything you've liked there in the rally you have seen in that part of the market?
So as the economy slows, because the Fed's raised rates from 0 to 4.5 in a year, and probably gives us a mild recession, this return to growth is probably going to last a bit longer, as people say, I think I can own some stocks that are less dependent on the overall economy, and that's why you're seeing this run in the growth stocks to include some of the big tech stocks.
So, Bob, how challenged is your view that we retest the October low, given what you just said?
I think we will. Look, every time we have an interest rate hike of this kind of magnitude, there's a bump in the night. We saw it over the weekend with the bank stocks. What's yet to be felt is the slowdown in the economy. Monetary policy, Fed action, operates on the economy with long and unpredictable lags. The bump in the night was, I think, the first warning crack. The economy will slow as well. And in fact, the bank issue, as you read the quote of mine, will in fact slow the economy some more. So I think earnings are at risk. That's what we need to focus on.
So, Bob, we need to talk about earnings. We need to talk about Fed policy. Dan Iverson of PIMCO said this could be a multi-month process. He spoke to our team here at Bloomberg. Always fantastic to hear from him. There has been a meaningful tightening of financial conditions and significant risk aversion that we don't think is over. Bob, that speaks to what you've said. He said this is likely a multi-month adjustment process. It's possible that the Fed pauses in March, and we do think there will be more reverberations around the banking sector. Now, Bob, let's put two competing forces together. If we are going to see tighter financial conditions off the back of this stress in the financial system, at the same time, if the Fed does pause and back away, net-net, is that good or bad for stocks?
It's not good. Look, I think what the Fed has already done is more important than what the Fed might do at their next meeting or the next couple of meetings. They may do nothing. They may raise once. I doubt they'll raise 2 more times. That's not important compared to the impact of what the Fed has already done that we've yet to feel, and that will slow the economy.
So where do you think the biggest earnings challenge might be in this equity market?
I think mostly across the board, as people are expecting, the recession word had basically left the vocabulary of Wall Street. Soft landing, no landing was the popular item. I think with this bank issue, we're going to see that word coming back in and earnings will come down. Obviously, the more cyclically oriented an area is, the more likely the earnings are at risk.
So, Bob, there are two camps. I talked about it yesterday. One camp truly believes that you can isolate the banking story. The Fed and regulators have the tools to address it. And the Federal Reserve can carry on focusing monetary policy on the inflation issue. Are you saying the former should shape the latter?
To some degree, yes. I like the fact that there were facilities put in place, particularly the ability to go borrow at par. That really puts a safety net on the things. And so we can park that to the side to some degree and then worry about inflation on the other. But I repeat, the actions of the financial sector and the overall pall that creates for consumers and businesses does a lot of the work for the Fed. I think what happened the last week is 100 basis points worth of tightening on the Fed. That will be the impact. Wow.
Bob Dole of Crossmark with a big call. Bob, thank you. Some people share that view. Seen some real tightening in parts of the credit market. Elsewhere, I'm looking at the S&P 500 up by 1.6%, the Nasdaq up by almost 2 full percentage points. And if I told you that payrolls would come in at 311, that you'd see inflation come in where it came in this morning, which was basically at 0.5%. on core relative to the 0.4 expected a week ago. After Powell spoke, there were people lining up to tell us on this program that meant a 50 basis point hike from this Federal Reserve. And then, of course, the banking issue seems to have changed a lot for a lot of people. Coming up on this program, inflation, keeping the pressure on the Biden administration.
We're expecting to see inflation ease over the year. There may be bumps along the way, however. We know that we can't focus on any one month.
Mike Gapin of Bank of America up next.
We understand that inflation needs to come down. It's why it's the president's highest priority. We're expecting to see inflation ease over the year. There may be bumps along the way, however. We know that we can't focus on any one month, but that is what most forecasters are expecting.
Well, there's some bumps right now. Today's CPI print keeping the pressure on the Biden administration to tame inflation. The White House expecting inflation to cool over the next year and into next year as well. AMH down in D.C. joins us now for more. Hey, Anne-Marie.
Hey, John, well, you heard from Celia Rouse there. Obviously, the president's new NEC director, Lael Brainerd, these individuals are going to be looking at what the economists look at, which is core CPI, which we did see pick up some space, especially that gauge that the Fed Chair Jay Powell looks at, core CPI, excluding shelter. That remains stubbornly high. These are the bumps in the road that the Biden administration is going to be looking at behind the scenes. But when the president comes out, and if he talks about inflation or if there is a statement, they're going to point to annual inflation. And that came in at 6%. It's the lowest since September of 2021. So the message from this White House is going to be there is still a lot we need to do. Inflation is far too high. But potentially they will try to say they are seeing some progress.
Anne-Marie used to join us at 10 past the hour, and then she got a new show, so it's been pushed back to like 9:50.
I was still here for you.
Sure. Down in Washington, appreciate it. Looking out to that program a little bit later, looking forward to it with Anne-Marie and Joe Matthew on Bloomberg TV and Bloomberg Radio. Stand on, 5 p.m. Eastern Time. B of A's Mike Gapin has this to say. We retain our outlook for monetary policy, a 25 basis point hike in March, terminal 525 to 550, ongoing balance sheet runoff. Mike Gapin, you wrote that before the CPI print. Have you edited it at all?
No, I haven't. We just think if the Fed, as you mentioned in your previous segment, if they're successful at kind of ring fencing and containing the financial stress for the moment, the broader macro environment, whether it's jobs, inflation, activity, consumer spending, still supports higher policy rates. So we think the Fed's inclined to keep that on track next week. And we look for them to lift the policy rate by 25 basis points and continue with balance sheet runoff. Obviously, that's day to day right now, dependent on market events. But that was our view yesterday. It's our view today.
Mike, why don't you think this SVB issue screams you're breaking stuff, you've done enough, was sufficiently restrictive?
Well, I certainly think it is a signal that financial conditions have tightened. There was a building narrative that the U.S. economy was impervious or immune to higher interest rates, and certainly parts of the economy are resilient to it, and consumer spending has maintained a lot of momentum. But there's other parts in the economy, housing, business spending, manufacturing output, and certainly, what we're seeing now with potential spillover into lending conditions that do reflect the tightening in financial conditions from the Fed. So I think it does tell you policy is restrictive, and we'll find out where exactly sufficiently restrictive is. I do think higher policy rates are warranted, but yes, the events in recent days do tell us Fed policy matters, and when you raise rates this fast, you sometimes get these financial stress events, and we're getting one right now.
Well, the banks are rallying today. I've got no idea what they do tomorrow. Day after that. I've got no idea where we'll be next week. But the here and now, Matt Lazzetti of Deutsche Bank, Mike, you might have seen this, you might not have. He's aggressively revised his terminal rate, his forecast from 5.625% down to 5.125%. Would you be thinking about doing the same thing, given that you're not too far away from that level either?
Yeah, entirely possible. We don't, as you were, I think, are alluding to, we don't exactly know where sufficiently restrictive is. We're still in the 525 to 550 camp, but yes, I think we're meeting by meeting here, we're week by week, and as the data evolve, we'll get a better idea of, is it something closer to 6, is it something closer to 5? So that's completely reasonable, and our visibility here, I think we should be a little humble in how far out we can look right now. So it's a reasonable outlook. I think they can go a little higher, but we're not that far apart.
Given the moves in the bond market, Mike, I'm with you. I can't get past today, never mind next week and months or two, year end, if anyone's trying to forecast that. Mike, something came up today, and I'd love your response to it. I know we can tie ourselves in knots thinking too deeply about all this stuff, but just the psychological story that this Fed has to confront on the FOMC next week. It was suggested to me this morning by two people, Priya Misra, TD, Vincent Reinhart, Dreyfus and Mellon, who suggested there was a psychological element to this, that if the Federal Reserve didn't continue hiking, there was some kind of acknowledgement that what they had announced on Sunday wasn't sufficient, and therefore they had to back away on monetary policy. Is there anything in that for you?
I would say a little. I think in defense of the Fed, the fact that these two things are happening so close together, the stress event and the meeting, makes it hard, I think, if they don't hike, to say, oh, then the ring fencing isn't sufficient. I mean, they just stood up these systemic risk tools on Sunday night, and today's Tuesday. So if they had to pause in March, they could certainly do that, and I don't think it would be an indictment of the tools that they've put into place. If there were more space between the event and the meeting, there'd be more time for things to cool down. But the bigger principle, the Fed can chew gum and walk at the same time. It can use its lender of last resort tools to quell financial market, stress, and It can also keep its broader eye on the macro economy. So the Fed's trying to do that, walk and chew gum right now. We'll see if they can. I think they can do it.
Mike, I've got to squeeze this in. We've got 30 seconds left. If Chairman Powell had day one of testimony in front of the Senate today, like he did this time last week, how different would that address have been?
Probably not so much focused on returning to a faster pace, but yes, a more kind of balanced assessment of dealing with stresses on one side, but still needing tighter monetary conditions on the other. And I do think it supports just, moderate rate increases until we figure out what the right rate is. So I think 25 makes sense for now.
We've got a ton to figure out. Mike Gapin of BofA. Mike, thank you. As always, great work. Looking at your session right now, 23 minutes in, equities advanced 1.5% outperformance. The financials finally up 2.6%, and the regionals bouncing aggressively. Your trading diary up next. So far, so good. Let's see if it sticks. KBW Bank Index, best day of the year so far. if the session closed here. Of course, the session's not closing anytime soon. Your equity market up by 1.4% on the S&P. The financials lead. That's the price action. Here's the trading diary. Coming up, US PPI, retail sales tomorrow morning. Housing starts, another round of claims on Thursday, plus an ECB decision and news conference with President Lagarde, Secretary Yellen heading to Capitol Hill, and finally closing out the week with UMich Consumer Sentiment Survey on Friday. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.